Thank you so much for joining us tonight. I think you're in for a treat. For those of you who have purchased a home, you know how difficult it is, and going back through the ABCs is something that we all need to do and take a refresher course in the event we want to do it again. For those of you who have not, I learned so much last night, having gone through it, about 20 years ago. And I wish that I'd had something like this when I went through that process. My name is Angie Juzang, and I'm the co-founder of Legacy Business League, and it's a minority chamber of commerce started in 2013, really formalized things about 2 years ago. And we bring information and resources to those who otherwise wouldn't know where to go or know where to start. And that's why Hancock Whitney is such a fantastic partner, because they do the same thing. They're making sure that those who just may not know where to go and who to talk to, that's what this is all about. And so we have a lovely panel tonight. Ms. Victoria Mckinney, she is with Mercy Housing, and she's going to tell us a little bit about herself in just a moment. Ms. Stephanie Johnson, she's with Hancock Whitney, and will tell us her role and responsibility, and she'll definitely assist with that information. And Ms. LaCarsha Babers, who's been my partner in crime in this and many other partnerships that we've had with Hancock Whitney. And welcome. And LaCarsha is going to walk us through what we're to expect tonight and Hancock Whitney's role in this.
Awesome. Thank you so much, Ms. Angie. And welcome to everyone that's on the panel, all of our attendees. We're so glad that you joined us. Special thanks to the Legacy Business League, our partner. Like she mentioned, we partner together on a lot of our events, and we have a great time. Thank you so much, Angie. This event actually started last night in the Baton Rouge market. Angie did an awesome job facilitating the event, as well as our community lenders were on the line and our community partner. So we welcome each and every one of you. As Angie mentioned, I'm LaCarsha Babers, and I'm the Community Outreach Officer for Hancock Whitney Bank. And what we are hosting tonight is a 3-part housing and financial empowerment series. This is the first session of the 3-part series. And tonight we're going to be talking about owning your own home. We're going to walk you through the process. But first, I want to give you just a little bit information about Hancock Whitney Bank. This event is sponsored by Hancock Whitney Bank. However, we are in partnership with the Legacy Business League, as well as our Mercy Housing organization. Victoria Mckinney is going to be our speaker from Mercy Housing. We're so excited about that. I've enjoyed working with you, Victoria. Great conversations, great opportunities that you and your organization are able to provide to the community. And we're grateful for having the opportunity for you to be here with us. Well, our mission at Hancock Whitney Bank is to help people achieve their financial goals and dreams. And one of the ways in which we do that is by providing access to home ownership. At Hancock Whitney Bank, we have over 200 financial centers conveniently located to help meet the needs of the communities we serve. We have financial centers in Alabama, Louisiana, Mississippi, Florida, as well as Texas. And what we've done, as Angie mentioned, being a first-time home buyer, it can seem a little overwhelming, but what our goal is throughout this entire process is to provide you with the resources and the tools, the guidance, and the instructions that you need to remove those anxieties, remove the overwhelming feelings that you might have, the fear, of course, to start your mortgage loan process. We're going to guide you through it. So don't be fearful. Don't be afraid. We're not going to leave you by yourself. We're going to walk you through it. That's our goal. That's our mission. So we're going to start tonight. Again, this first session is going to cover your mortgage loan process, and we'll do a deep dive with our community partners. They're going to talk to us about owning your own home. What are the advantages and disadvantages? They're going to also talk about the process. They're going to let you know, who do you contact? Who is going to be the contact person? Who do you reach out to? They're going to talk to you about the terms. You need to know who's who in the mortgage loan process. A lot of times you hear the appraiser, the appraisal, the mortgage loan originator, the community lender, and we want you to know who those individual persons are and the role that they play. So our community partner Victoria is going to walk you through that process. And then we have our very own community lender, Stephanie Johnson. I just love working with Stephanie. She's going to talk to us about the road to home ownership. Now, there are 5 factors used to determine a borrower's ability to obtain a home, but 5 factors But tonight, Stephanie's going to talk to us about 2 of those 5 factors. She's going to elaborate on character and capacity. And I've heard her talk. She does such a fabulous job doing that. So I'm not going to prolong the time any longer. I'm going to let them go ahead and start their process. But I do want to remind everyone that this is session 1. We have 2 more sessions coming up. Session 2, we're going to come back to you the month of May. So whatever outlet you found out about this particular event, we want you to go back to that same outlet, because Angie is going to make sure we are informed on how we can register for the month of May. During May, we're going to talk about credit management, budgeting, as well as financial health. Then we'll come back and end it up during homeownership month, which is June, and we're going to elaborate on and get a deeper dive on the mortgage loan resources. So Stephanie's going to prepare herself. She'll talk just a little bit about those resources that we provide, but she's going to do an in-depth presentation during the month of June. And I promise you, you don't want to miss it. Again, my name is LaCarsha Babers, Community Outreach Officer, and I'm excited. I'm so excited about the opportunity to share with our community the mortgage loan process. Angie?
Okay, fantastic. Wonderful, wonderful. Okay, so we are going to get, we have a slide deck actually that I'm going to go ahead and share, and Victoria is going to go through the first few slides, and then Stephanie is going to take over from there. But I would like, Victoria, if you would go ahead and tell us a little bit about yourself. I know it says HUD Certified Housing Counselor for Mercy Housing and Human Development. I must say, I had the opportunity to meet with I think it's the executive director or CEO last year. I was doing some grant assessments, and I hate to say that I'd never heard of Mercy Housing before. And when I left there, I was so very impressed. And the fact that anybody can come and get, some of your services, and that you would help people do some of the things that you're going to tell us about today. So would you tell us a little bit about Mercy Housing?
Yes, sure. Thank you. So my name is Victoria Mckinney. I'm a HUD certified counselor with Mercy Housing and Human Development. And our main focus is primarily first-time homebuyer education. So educating you on the entire process. We cover, credit counseling, money management, and all the aspects that go into purchasing your home, as well as covering the different down payment assistance and grant options that are available out there. Outside of that, we also do foreclosure prevention counseling. We do ACA navigation and helping with marketplace health insurance, as well as free tax preparation every year.
Fantastic. Okay, so let's go ahead and I have some more questions for you as we go through this to see, about the partnership and how people get in touch with you and things like that. But we'll go ahead and let me go ahead and share my screen. Can y'all see it now?
Yes.
Okay. All right. I'm going to hop off camera and let you run the show, and you just tell me when you want me to advance the slide. Okay. You're on mute.
It didn't work the first time. All right, so I'm ready.
Here we go.
So the first thing that we're going to be talking about is going to be the advantages and disadvantages of owning a home. So there's always going to be pros and cons with anything in life. That's just inevitable. So just some of the things that would be considered an advantage with owning a home is going to be building equity, and you can borrow against it. So equity is going to be, equity is something that you build over time, value within the property as you pay down your mortgage. And then once there's so much available, you'll actually be able to borrow against it. Things like home equity line of credit, home equity loan, in case you need to use that for something else. It's a good investment. You can make improvements to it to increase the price. Property values can go up over time depending on the housing market at the time. Then you've also got tax deductible mortgage interest. So you'll get a mortgage interest statement at the end of every year. You'll file it with your taxes, and that will help with your deductions. Then you also have it as an asset for your family members that you can pass on to. With that being said, you do want to make sure that once you purchase a home, you want to get a will made so that if in case anything happens, you know exactly where you want that property to go. Some other advantages, customizable. You can add on to it. You can paint the colors of the walls, whatever you want. You can put as many holes in the walls as you want. You can do whatever, add an in-ground pool, and so on. And then there are also going to be disadvantages. So you can go on to the next slide. There we go. Okay, so some disadvantages. So property maintenance and upkeep. Everybody always talks about how they would rather own versus renting. But one thing that they don't take into consideration is normally whenever you're renting, most of the maintenance is done for you. If something breaks, it's going to get changed. You know, fridge, dishwasher, AC, roof, windows, all that stuff. Once you purchase, you're now responsible for all of that. So you're going to have to cut the lawn. You're going to have to clean the gutters. If something happens to the roof, you're going to have to replace that, trim trees, trim bushes. You got vines, you got to make sure those are cut down so they don't destroy your property. But it can also be rewarding as well. Then you've also got not as easy to move as renting. So with renting, typically you have a year lease. Sometimes you may have a 6-month lease or a month by month. But if you own the property, you're going to have to list it for sale and get it sold before you move somewhere else. So that's selling and putting a house on the market, making sure it's up to date, then there's no issues, and hoping that the contract doesn't fall through. It's kind of a lengthy process, so you can't just get up and move. And then there's also risk of losing your home. So this is through foreclosure. Something happens and you're not able to make those payments, you could potentially lose your home. Some other things might be, you may not be too fond of your neighbors. They may be loud or noisy. So it's just some things that you need to take into consideration whenever you're looking to purchase a home. You may want to do drive-bys early in the morning at places that you're interested in, or late at night to see how the environment is. Are there kids running all over the place? Maybe you don't want to deal with kids. So those are just some of the advantages and disadvantages of owning a home. Okay, next we have readiness to buy a home. So these are some items and some questions you need to ask yourself, and that we can, as Mercy Housing, we can help you with. Make sure that, do you have a steady source of income? So have you had a steady job for the past 2 years? And it doesn't have to be the same job, the same position, but it has to be within the same vein, same type of employment. And then if you're self-employed, you're going to have the last 2 years tax returns. So your self-employment business has to be open for at least 2 years before that can be considered. Good credit history. Do you make on-time payments? How long of a credit history do you have? What kind of credit do you have? Do you have a good mixture of credit? Credit cards, installment loans, not a lot of them all at once, but just so that lenders can see that you understand how different types of credit work, as well as utilization. How much of your credit are you using at one time? Inquiries, how much credit are you applying for at all at once? How much debt are you trying to take on in addition to trying to purchase a home? And then, are you planning to move within 2 to 3 years? So if you're going to move out of state due to family or due to job, it may not be a right time for you to purchase a home if you're just going to move in 2 to 3 years. Money for down payment and closing costs. So this is going to be, money for down payment and closing costs. So how much do you have set aside in savings to be able to put that down for a down payment and to be able to cover your closing costs? So those are just some factors that go into readiness to buy a home. Okay, 5 steps to buying a home. So you want to determine your readiness to buy a home. So that's going to be looking at what your debts are, determining your debt to income ratio as well, which is how much money you have coming in versus how much in debt that you have going out. Do you have any collections, judgments, liens, anything negative that might get in the way of you closing on a home? Determining how much mortgage you can afford. So that's, again, it's going to be based off of what your income is, how many people are in your household, determining which mortgage option is best for you. So there's different types of mortgages out there. You've got your conventional, FHA, VA, USDA, and depending upon your income, if you're active military, veteran, and all sorts of other different factors will determine which type of mortgage is good for you. Then you have to qualify for a loan. So this is the application process. This is going to be you gathering all of your income documents, all your assets, and seeing how much you can qualify for. And then, of course, that's also going to include finding that home, going under contract, getting the insurance squared away, and then going through settlement. So this is when you've been approved and all that other stuff's out the way. Going through settlement is closing. You can go on to the next slide. Okay, so who's in the mortgage lending process? So these are different terms associated
I'm
with.
sorry, I was trying to get off mute before we move on to this. This is the technical difficulties I have for yesterday. I don't know why. It's doing that to me. But at any rate, I wanted to ask you some questions before we move on to this part. Thank you so much. That was really good information. So you talked about the advantages and disadvantages of owning a home. Tell us, like you said, if you own a home, you can do what you want to with it. You can put holes in the wall. You don't have to, worry about a deposit and such. But so many people, this is the American dream, right? Everybody really wants to own a home, but talk about, why is it important for someone to consider buying a home versus renting for the rest of their lives?
There are people out there who are happy renters. And that's usually because all the maintenance is taken care of for them. They have a good landlord. Maybe they're in a personal property, or maybe they're in a complex. Maybe the community is good. But I see it typically as it being not having to deal with all the maintenance and having that good landlord. So versus
it's an asset to purchase a home, and that's why you need partners like Hancock, Whitney to kind of walk you through it, and then of course getting ready for it. You mentioned, like, if you're self-employed, I'm sure there's some entrepreneurs on tonight. Can you give us a little color around that process? Because I think I personally had some people say, I'm never going to qualify for a home because I'm an entrepreneur. I never really know, how much money I'm going to be bringing in. It's, it's not.
Yeah, and
steady.
that's why they want to see that past 2 years, because they, need to evaluate what your income is. They're going to look at that 2 years, and they're going to get an average of what your income is and use that.
Okay, I see. Well, that makes sense. And you touched on, credit, your credit history. Talk about a little bit about what Mercy Housing does to help people who may come in with either poor credit or no credit, because from what I understand, no credit is bad credit. So what kind of programs do y'all have available, or what kind of coaching or counseling do you do?
Okay, so we do offer credit counseling, either standalone for someone who's just looking to improve their credit score or establish it, or for individuals who have home ownership in mind. So that we do a soft pull on their credit report. So soft pull meaning that it does not affect your credit scores. You're not applying for credit, so it's not going to affect your scores. We pull from all 3 of the credit bureaus. We'll go over the entire report with them. So if they have, for one, if they have any sort of errors like duplicates, accounts that don't belong to them, accounts that have been paid off and they have proof of that, we can work with the credit bureaus and get that updated and corrected. And then if you have collections, charge off accounts, anything negative on there, we'll coach you. If you have a lot of stuff on there, we may have to prioritize. Like for instance, if you do have multiple collections on your account, it's best to negotiate with the newest non-medical collection accounts because they have the biggest impact on your score. So we help prioritize debts that they may owe, correct credit reports, and then also create an action plan so they know how to move forward. And then we also cover as well, even though it's credit counseling, we do still go over their budget and look at how much they have in savings and create a plan just for that as well.
Okay. And some people, think that it is an easy process or that, and like, so talk about not getting discouraged, that sometimes it'll, take a little bit of time.
Yeah, it's really hard for some people to not be discouraged, but it really comes down to making this your goal and not your dream and being determined, because anybody can achieve it. It just comes down to doing the work. So you have to want it. So we can all day long tell you what you need to do. You follow these 5 steps and guarantee you that your credit's going to increase and you'll put yourself in the position to purchase a home, but you have to do it.
That makes sense.
So sometimes you just have to remind them that, this time is going to pass anyways. So are you going to make use of that time, or are you going to let another few years pass you by before you decide to really get down and get stuff done?
Yeah, that makes sense. And being persistent. LaCarsha, did you have something to contribute?
I did. I'm loving this. Thank you so much, Victoria, for the great input, and you as well, Angie. You always know the questions to ask. Good questions, always. You get us thinking. but one thing I heard you say, Victoria, about building equity in your home. I like that statement because so many individuals sometimes maybe they didn't get a chance to prepare for their children's education as others have. And if you have equity in your home, sometimes they could use that equity to help with their children's college fund, or maybe to even improve the home that you're living in now. Yep. So those are some good points, and I also thought about owning a home is a key component for creating generational wealth for your families as well as your communities. So we encourage individuals, it may seem like a tedious process, but we're here for you. And you have partners such as Mercy Housing, Hancock, Whitney Bank that will walk you through the process. And we can't stress that enough. We're here to provide you with the guidance, the resources, and the tools because we know that you're hungry. You're hungry for these things. That's why you're here. So thank you so much for joining us. But I do want to say, after you finish your presentation, Victoria, please, if you will, add your contact information in the chat box, because I'm sure after this presentation, they're going to have some questions and they would love to contact you. And I'm going to ask at this time, and then I'll turn it back over to you, Victoria. We have some mortgage lenders and some community lenders on the line. Thank you so much for tuning in. I'm going to ask, if you will, at this time, to add your contact information in the chat. So if anyone that's on the line, they have additional questions or they're ready, to start the process, they can contact you. Let them know what financial center you're located, your contact number, and your name. I would appreciate it to the highest. Victoria?
Yes. Okay, and so we'll go back to the slide presentation. If you see it toggling back and forth, that's just me trying to get back on camera. It's like, I don't know what happens, but there we go.
Okay, so we are.
I'm trying to get off camera. Hold on. I don't know why it's
going.
Stay on. I'm trying to. There we go. Finally. Okay.
All right, so now we're going to talk about the partners in lending. So these are key individuals in the mortgage process. So you really want to know the difference between these. I know it can get a little confusing, especially because there may be more than one term for each of these individuals. So first we have mortgage loan originator. So explains the mortgage process to the borrower and takes the applications. So when you go to the bank and say, hey, I want to apply for a mortgage loan, you're going to be partnered with a mortgage loan originator or a loan officer, as they'll call themselves as well. And they're going to talk to you about what you're looking for. They're going to ask you what your income is, what your debts are, to just kind of get an overview of what they're dealing with, as far as what you have going on, to see what you might be eligible for. You also have the mortgage loan processor. So this may end up being the same person as the underwriter. So assist the loan officer with gathering borrower information and prepares the file for underwriting. So underwriting is going to be when the application has been completed and the supporting documents have been added to that file and it's been submitted to the underwriter. So we'll go ahead and skip down to mortgage loan underwriter real quick. So reviews the loan file, may request additional information, which usually they do end up doing, conditions, and then approves, counter offers, or declines the file. So then we have appraiser. So performs an assessment of the home to determine a fair market value. So appraiser is going to look at what other houses in the area, in that neighborhood, are priced at. They're also going to look at the house itself, the property, and maybe some of the interior, just to give you an approximate value. And then you've got mortgage loan closer. So this is an individual who prepares the file for loan closing and works with the title company to request additional information required to close the loan. So this is whenever you go to closing, you're going to meet with the closer, the loan closer, and you will have your real estate agent there as well. And sometimes your loan officer will show up as well at the closing. So this is where you're going to sit down and actually go through all the documentation and sign. And this is where you're going to sign your deed as well. And then they'll give you your inspection. There will be like a copy of your inspection report and some other stuff in there as well. And then title company. So this is the individual that performs a title search of the property, prepares closing documents, and closes the loan. So they're going to, as far as doing title searches, they're looking to make sure that nobody else has interest in the property and there's no liens or judgments on the property either. So those are the key partners in the lending process. But then, of course, there's also HUD-approved housing counselors as well to help guide you through that process, to interpret stuff for you, to help you gather all your documents, make sure you've got all your ducks in a row. You're on mute.
So when you say the HUD-approved counselors, you mean someone like you?
Right.
Okay. And that's a reciprocal relationship that you all have, is that, when you're working with somebody, you can recommend, a bank as a partner, and then vice versa. Like, hey, if you need help through this process.
Right. We can give recommendations out for banks, but it has to be at least 3 because we're not allowed to steer. We
Gotcha.
Can't have any sort of interest in anything. So, we have to give them at least 3 to choose from.
That's good to know. That's good to know. Okay. Now with this process, you like how you have your realtor, and your realtor kind of walks you through some of these things, and they're
yes.
usually your go-to person. Is there like a go-to person out of here that you would say they're your partner throughout this process? And would that be more of the HUD-approved counselor, or somebody inside as the bank partner? And I know LaCarsha or Miss Stephanie.
Well, I think both are super important to have, because, like I said, a HUD-approved housing counselor has no interest in any way, financially nothing. So we're strictly there for the good of the borrower. But it
Excellent.
is also important to be able to go to your loan officer to express anything that may be going on.
Gotcha.
And get
That's
insight
okay.
from both
That's
sides.
perfect. Okay, loan officer. Okay, so we're gonna go to terms to know in the mortgage process.
Yes.
I'm sorry, I don't want to interrupt, but we have a question in the chat box. Very
Please do.
good question.
Generally, how long does it take from the initial process of starting the loan process to the closing of a house?
Okay, so if you're going super speedy and you already have your house picked out, it can be 30 days. Now I know lately with the way the market's been, it's been taking 60 up to 90 days with how congested everything has been. So I think right now it has been an average of 60 days, but you can get through it within 30 days if you dot your I's, cross your T's, you have everything figured out, ideally.
Yeah, I started I put my house on the market on a Friday. I think it was October October, whatever the third Friday was in October. I had 6 showings that day with all 6 making offers. Saturday, the realtor even asked me, Angie, do we even show it today? Because these are really good offers. We did. Got everybody except for one made an offer. I was out of the house by November 1st. Out of the house and closed and everything by November 1st in selling it. So that's how fast, but that person was ready, and
did
that's
they pay
that's
cash or did they apply for a loan? Did they have
all
like
of them? There was only one cash, and then everybody else were loans from VA to HUD to conventional. And so I know that they're going to talk a little bit about the difference between pre-qualification and pre-approval. And then, the realtor was like, hey, this person's been pre-qualified, this person has been pre-approved. And she explained to me what the difference in that was and the advantages of either. So we can talk about that too. LaCarsha, were you going to say something?
I just wanted to see if any of our community lending officers or originators had any input as far as the closing timeframe. Just feel free to take yourself off of mute if so.
Yes, I'll say something about that. That time frame depends mostly on you. We have a start date. We try to push the process out as quickly as possible. When we get conditions to clear, we've given you a pre-qual letter. And once you get in that contract, we start moving that contract. We look at your closing dates. If your agent have set your date for the 30 days, we're working toward that. If we can get it closed in 15 or 20 days, we'll do that. But we do not give you unrealistic expectation, because if you have not returned the information or the documentation that we request at the beginning, we go into the loan asking for as much information or documentation upfront. Like we might say, I need 2-month bank statements, I need 2 years tax returns, I need W-2s, I need 1099s. Well, you bring me a perfect 2-month bank statements, 2 years tax returns, all my W-2s. But then if you just give me W-2s that you think I should have, well, we're missing W-2s. Well, we have to come back to you again. That's another condition. We'll say, okay, we can't submit this unless we get everything that I've asked you for. Now, that's what moves your process fast, because our underwriters is not going to keep turning around looking at one piece of paper if you get it to me one at a time. But if she get me everything that I asked for up front, we can move that thing, and we're pretty much pushing the builders, if you're building a house, to get it closed, because we want to get it closed as soon as possible.
That's good. I like that.
We have another question. How soon do you need to get a realtor? I'm assuming in this process, or does Mercy Housing pair you up with realtor?
We do not pair with realtors. Again, same as with lenders. If you just don't know where to go and you want some suggestions, we can give you at least 3 suggestions, more if you want more. And then we, of course, always encourage you to ask co-workers, family members, if they've purchased, who they use, to get outside recommendations as well. What was the other part to that question?
There wasn't one. That's
The
good.
one that,
How soon do you need to get a Realtor?
how soon? Okay.
Okay, yeah.
So really, whenever you are ready to get pre-qualified, then I would go ahead and get a realtor. And we do provide a worksheet, if you will, with things that you have to have, you would like to have, you don't want in a house. So you can write down everything ahead of time and have it ready to give to your real estate agent whenever you find one, so they can take it and they can run with it.
Excellent. Okay.
You can get, I'm sorry, you can get one anytime before that if you want, but they're really going to be ready once you get that pre-qualification, so you know about how much money you're working with as far as when you're looking to purchase a home.
Yeah. And what I've also found too is that, you know, if you obviously you're going to buy a house, and often the people selling the house,
Mhm.
the you know, real estate agency
The
or
seller's agent.
even, they usually require that you have representation. So you know, you might drive around and see a house and want a realtor to represent you to be able to, you know, contact the person that's selling it.
Yeah, and you can represent yourself, but we don't really encourage that because you don't whenever it comes to closing, you don't pay for your real estate agent. The seller pays for both the seller's agent and the buyer's agent. So there's really no reason not to work with an agent, because they're going to be busting their butt trying to find the things that you are looking for and get those listings to you as soon as possible, as well as they have access to a system to see what listings are available before they're made public online.
Okay, so we're going to continue with the terms to know in the mortgage process.
Okay, all right. So need to know terms. So we've got borrower. So that is the individual who is looking to apply for the mortgage loan. Borrower, co-borrower. So if you and somebody else are going in to purchase, you don't have to be married. So if it's you and anybody else who is wanting to go on apply for the loan together, you've got your borrower and your co-borrower. Then you have the creditor. So this is going to be the lender. So this is the individual who is lending out the credit. And then you've got interest rate. So this is going to be the cost of borrowing money. I'm pretty sure that most people know what interest rate is, because it's not just with mortgage loans, it's pretty much with anything that you borrow money wise, auto loans, credit cards, any of that. Annual percentage rate, or APR, is the cost of credit expressed at a yearly rate, which includes the interest and certain fees that the borrower is required to pay. So this is going to be your interest rate plus any other fees associated with the loan. Then you have down payment. So this is portion of the price of the home, usually 0 to 20%, not borrowed and paid up front. So this is how much you're going to pay up front. So this is going to depend on the type of loan. For instance, with a USDA or a VA loan, you may not have to put anything down at all, do 100% financing, which means that the entire purchase price is the loan. Then you've got your FHA, which is going to be 3.5% of the purchase price. So whatever the price of the property is, it's going to be 3.5% of that is what you have to pay up front. Or you've got typical, like standard conventional loans, which usually require a 20% down payment. Now, there are also what are called portfolio mortgages and loans out there, which are basically like in-house products that an individual lending institution has created. So they may have slightly different guidelines for, maybe it works as a conventional loan, but you don't have to do the entire 20%. They may roll that into the loan itself, or they may have some other certain conditions to lower that down payment type. Let's see. So then you've got private mortgage insurance. So a type of insurance to help protect the lender from losses in the event a homeowner defaults and loses their home in foreclosure. So this is, you've got your regular homeowner's insurance that covers your house, but then you also have private mortgage insurance. This covers the lender in case you can't make payments on your loan and you default and you go into foreclosure. So private mortgage insurance is for conventional loans. There's also something that's very similar to this called private mortgage insurance. I'm sorry, mortgage insurance premium, which is for FHA loans. So that being said, with private mortgage insurance, this is for if you put like you have a conventional and you put less than the 20% down, they may tack this extra insurance on until you build 20% equity into the home, and then they will remove it. Next, you've got closing costs. So this is costs to complete the real estate transaction. Costs include but are not limited to points, which is like paying to bring down your interest rate, taxes, so property taxes, title insurance, so for the title, financing cost, prepaid, and escrows. Let's see here. And then there's some costs that are actually called upfront costs that are paid before closing. And that's going to include like your inspection, appraisal, and something called earnest money, which is whenever you go under contract with a house. So you found a house that you like, you put a bid on it, the seller accepted it, so now you guys are under contract. They usually require you put, like $500 up front to ensure that you were really interested in purchasing that property. And then you usually get that back after closing is completed. Then you've got PITI or PITI. So this is short for principals, interest, taxes, and insurance. So this makes up your total monthly mortgage payment. And in some cases, there are what's called association fees or homeowner association dues. And this is for communities that have an active homeowners association, which is like those people that go out there and tell you that your grass can't be higher than like 2 inches and that your mailbox is too tall, your fence can only be so tall, just to help make the community look nice. So those are usually a yearly fee. And then you've got your escrow account. So this is an account with the lender. It's a separate account that holds your insurance and your property taxes. So every month that you make your regular mortgage payment, your insurance and your property taxes are put into that escrow account. And then once a whole 12 months has passed by, then it pays out to your insurance agency and to for the property taxes.
Okay. Okay, Victoria, is there anything else that you want to contribute to the information that we've presented, or to tell the group how Mercy Housing can assist?
Like I said, we'll guide you through the entire process. So you come in, we provide first-time homebuyer education course, so that we haven't started back up our in-person course, but typically we do in-person or online. Those are 2 options that are available. So once you complete the pre-purchase education class, you receive a certificate that's good for 2 years that proves that you've gone through a HUD-approved class. And then from there, we usually do the credit counseling, so getting them credit ready. And then we go over the down payment assistance program, see which ones they may qualify for, give them the information to pursue those options. And then if they want information on lenders, real estate agents, insurance agents, we'll give them information on that. And then make sure that they have the information they need to make sure that all their documents are in place for when they apply for the loan. And then once they close, we also offer post-purchase counseling, which is going over their closing disclosure to see what was going on with that, and then go over home maintenance. And then I like to do a little bit of foreclosure prevention, just to let them know, hey, you know, if anything happens, make sure you're always in contact with your lender. Let them know what's going on immediately. Cover, you know, I'm sorry, my mind just went blank.
Yeah, that's okay. I mean, that's a lot. I mean, you know, for you to remember all that anyway. I mean, obviously you're passionate about what you do. You mentioned this certificate, and I learned a little bit about that last night in the other seminar. That's important, right?
Yeah.
So tell us a little bit about why that's important, what it is and why that's important.
So if you're a first-time home buyer, a lot of different down payment assistance programs are going to require that you go through a HUD-approved pre-purchase class to be eligible to apply for those grants and assistance programs.
And it provides some type of credibility to the when you're able to show up with that certificate and say,
Yeah.
hey, I've done this.
Oh yeah.
Okay, well, unless anybody has any questions for her, I'm looking here, I don't see any. She will still be around. She won't be on screen when we bring up Miss Stephanie, but she will be around, so please know that you can ask her some more questions. So we're going to keep it moving. Thank you so much, Victoria. And Miss Johnson, if you can come back on screen, we're going to start talking about the mortgage application process and the 3 phases of that, and then hit 2 of the 5 C's.
Okay, thank you for that bringing me in. I'll talk to you about the mortgage process. My name is Stephanie Johnson. I am a community lending specialist officer with Hancock Whitney. I'm very passionate about the work I do and the opportunity to serve you and guide you through the mortgage process, the mortgage application process. We're going to start with the 3 phases of the mortgage application process. First, we'll talk about the pre-qualification, whether you make a loan inquiry by phone, online, or in person during the pre-qualification phase. Your lender is gathering information provided by the borrower, by you, or on your income, your debt, what we call installment debt, credit card debt, revolving, and from that information, we give you an estimated price range that you can determine whether with the information that you provided to us, whether you want. Now, I think last night we kept talking about affordability. We're really just giving you the pre-qualification. We're not telling you that you can afford it. We're just getting you pre-qualified. A lot of times, information you provide to us is subject to change. Once it is verified, the borrower has not selected a property yet. This is all a pre-qualification. Then we move to the conditional approval. A property has been selected. The lender have received a signed, executed, accepted purchase agreement between the borrower and the seller. The borrower submits a residential mortgage loan application and signs their mortgage disclosures, which states their intent to proceed. That's the most important part of some of your application when you do the mortgage application, because we have to know that you intend to proceed. So we have to get that. I think somebody asked about how quick does this process go? Well, we're watching for those disclosures to come back to see if you intend to proceed. We've had a lot of people applying, applications coming over, and then once they did their home inspection, they decided not to move forward with that. So they would not send disclosures back, telling us they intend to proceed. So at that point, if you don't intend to proceed, we stop the process. So we wait on a home. We don't wait for the home inspection. If your realtor have you doing a home inspection, we're moving the process once you've made the application and have selected a property. Your final approval is your employment. We have checked your employment. We verified income is accurate. Credit and assets is reviewed. The appraisal report approved, sent out to you showing the property value supports what you're paying for it, and is what you've agreed to pay for it. Everything is reviewed, verified, approved by the lender. The file is ready to close. The next slide, please. We have identified 5 key factors used to determine your ability, but we're going to just talk about 2 tonight. Your character, that's information we have gathered in the application process, building your profile, that's telling your story. Now, when we're doing the application and we're talking about your character, actually your loan officer, hopefully in the pre-qualification process, you've discussed with that loan officer any concerns, anything that you may think come up that we don't see, because what we're going to tell your story to our underwriters. We're building your profile. We're telling your story in the application, making sure your name is correct, your social security number is correct, your birth dates are correct, previous addresses within the 2 years. There's a 2-year window. Like sometimes when a person does an application online, they'll put in the current address they're staying in, and they've only been there 9 months. Well, we have to go back at least 2 years and track where you've lived. We require 2 years of where your residence, where you're living at. And then we talk about the purpose of the mortgage loan in that. We talk about your employers. I have a lot of people that when they're giving me their information, they'll tell me about the employer they're currently on, but they've only been on that job 9 months. They didn't give me the information on the previous employer. We have to backtrack at least 2 years of employment. So whether it's the same job or a new job, we have to go back at least 2 years. If it's 2 years, then we don't have to go to a previous employer. So and we look at your when you turn in your tax returns, a lot of times when we're doing the application, we're taking your information, and when we get your W-2s, we find out there was an employer you missed, and usually you'll say, or the customer or the borrower will say, well, I only worked there 1 month. It don't matter if it was 1 day. If you received the W-2, we need the information on that employer if it's within our 2-year windows and it's on your tax returns or your W-2s. The purpose of your mortgage loan application, we're going to find out what that purpose is. If you're a first-time home buyer, is it a second home? Are you purchasing another home? Are you downsizing? Are you refinancing? If there is a co-borrower, we're telling your story so that when our processor gets into processing it, we've done a good enough job in the application to tell your story. So the capacity, that's your mortgage affordability. Qualifying income, if you've been on the same job for 2 years, I think Ms. Victoria talked a little bit about that or more. Overtime can be average with your base pay. If only a couple of months, then we can't use that income for qualifying. Your gross versus your net. Sometimes when we do online applications, a lot of times some of the customers, when we are looking at when we did a pre-qualify by the information they gave us, and we did not look, the lender did not see your check stubs or information on your income. When we see you started out giving us your net, we will use your gross for qualifying, not your net income. Your gross and net income is on your W-2. We use 2-year employment histories, wage earners, pay stubs, and W-2s. Commission, tip, bonuses, those are averaged over 2 years. Part-time, seasonal, and second jobs, those are averaged over 2 years. So it's a difference in qualifying income. You can give us those employers, you say, well, I work 2 jobs, I have a second job, but you've only worked on that second job for a month. Well, okay, for qualifying, I'm gonna list the second job, but I can't qualify you for this mortgage on that second job if you've only had it for a couple of months or less than 2 years. If you've had the second job for at least 2 years, then I can take that second job and use that income, or 3 years or more, we can use that income and average it out, because of a second job, most of the time you're not working a 40-hour work period. So we have to, and those hours sometimes, fluctuate. Now, I will say this about your gross pay, and if it's your base pay and you're a 40-hour employer, because I've had this employee, I've had this come up lately in a loan that I'm working on. The employer gave us a verification that that person works 40 hours at $20 an hour, and they make this amount. And that's what we used to start out with. That's what we got. But then when we receive check stubs over a month, like if you get paid twice a month, we're going to ask for 2 check stubs. If you get paid weekly, we're going to ask for all the check stubs in that week of that month. If you get paid once a month, we're going to ask for that check stub. If that check stub does not support 40 hours, then you'll have to explain. That's what we're doing. We're going to be there to tell your story. You'll have to explain to our underwriters why you're a 40-hour employer, but you've only received an average of 35 hours. So we have to do our work to help you through the process. We will be there continuously to help you. We're there to do, whatever we need. I'm passionate about, people on this call know how I am about my customers. I'm going to make sure that they understand. If there's something I don't think they understand, I'm going to be right there to explain it to them and go through everything with them on that. You have wage earners, pay stubs, W-2, commission, tips, bonuses, average over 2 years. If you leave a W-2 job and you go to a commission job, I've had this. Well, you've changed your employment, so we can't use that commission income along with you work 2 years, but we can't use the commission income and put it with the W-2 income, because now your job has changed from a W-2 employer to a commission job. So those are the things that we explain to you up front during the pre-qualification process. Now, next, let's go to additional income. Let's talk about that. Social Security income, your disability and your retirement, child support. There has to be court ordered. We will ask for divorce decrees. Now, I think we were asked the question about the time frame. When we ask for documentation, if you have child support income coming in, if you have a court order, divorce decree showing the income, if we can get all of this document, if you disclose all of this documentation to us, we will actually make sure that we get everything necessary to submit your mortgage application.
I want to jump in here for just a second. I want to make sure everybody is still on mute. There seems to be some type of buzzing or feedback that we're getting, and we're going to try to eliminate that. We did have some questions that came in, and we'll go over there once you get to a stopping point.
Okay.
I think we'll continue, and then once you get to a stopping point through the building your profile would be good.
Okay, so building your profile is what we're on the mortgage application. This is where we're telling your story. That's what I was telling you in when we were talking about your character and your capacity. We're giving all the information that we submit on the mortgage loan application is actually the information that you've provided to us in the pre-qualification part of the application, or if you just went online and did an application because you're ready to move through with the process. We will tell your story. We need to be accurate as possible when we submit your application, your documentation. Usually the application covers everybody that's involved with the loan. It's gonna tell the purpose of the loan. It's gonna tell how many borrowers. It's gonna tell whether there's a co-borrower. Now, it's gonna tell us if you're married or if you're filing, if you're applying for a mortgage as an individual. If you're not married and say there's two people on your application, well, you're both borrowers. So usually one borrower will have 6 pages of this application. We have to tell the story of that first borrower. Then the next borrower, if you're not married, we're pulling 2 different credit reports, and we're getting documentation from the other borrower. So the co-borrower and the borrower, both of you are considered borrowers if you're filing for a joint application. Now, if you're married, then that is a joint application where we pull 1 credit report joint. All the information we take is, on each borrower, both the borrower and the co-borrower, the income, check stubs, bank statements, tax returns. If you're individual borrower that's on the same application, you have to submit your individual information. But when you're a joint borrower, we can take bank statements, check stubs, tax returns that you filed joint or have joint information. And the main part of that application is the page 6 that we talked about. We'll talk about. There's a line in there that tells you that based on the information that you've given us and the documentation that we've gathered, that to the best of your knowledge is accurate. You have given us accurate information because we're trying to base a loan approval on that, because now we're going for the final approval, getting ready to go to the final approval. I'm gonna stop right there, and if they have any questions right there, let me just stop right there.
I do have a question. Where
go
in
ahead.
the process do you fill out this application? So, I mean, I gave the analogy when I was talking about this before. When you're buying a car, you can do it one of 2 ways. You can call your bank and you can say, "Hey, listen, I want to buy a car. This is how much I want to spend, per month." You fill out the application. They give you, the range that you can do, and then you go out to the dealership or to whomever and say, "This is the car I want. My bank's going to finance it. They'll cut you a check." Boom. And so you fill out the application with the bank, or you go to the dealership, and the dealership, you find the car, and then they work to help with the financing, and then the application comes later. So what chicken or the egg? Do you get the house first, get your realtor first, and then fill out the application? Or do you go into mortgage lending and say, "Listen, I'm interested in buying a house. Let me figure out the financing first"? Like, I'm sure there's all different kinds of scenarios, but what do you recommend? I don't know if you can make a recommendation, but when does it usually come in the process, filling out this application?
Most real estate agents in this market lately, because of so volatile, will really not show you a property unless you come in pre-qualified. So most of the time you've gone to a lender, or they will suggest that you go to a lender to get pre-qualified. That's the pre-qualified part of it. And most of the time when you're coming in to get pre-qualified, we've we have a file that we call a prospect file. We've taken your information and we've put it over there in the prospect and in the beginning, we've issued you a pre-qualification letter based on the information that you gave us. Okay, at that point, then we would suggest, or you may already have a realtor that's telling you, I won't show your property until you pre-qualify. Well, then she get an estimate of what you will qualify for. And then that's when you go out there to her and start looking at property. Because I have agents that, or people will call and they say, I'm riding around and I'm looking in this neighborhood and I want to know if I qualify for this amount. Well, just like I think Ms. Victoria said, I suggest that you have a real estate agent, because if you're just riding and going in, you may be talking to the seller's agent. Okay. That's not a good thing to do, because the seller agent has the best interest of the seller. And the most that they can sell that house for, they're really not going to do a lot of negotiating for you. But if you have your own agent, if you've kind of, now Mercy Housing, Ms. Victoria said, they will help you with references of real estate agents. I suggest you go out there with an agent. Okay, well, we have already did the pre-qual. We have already issued you a pre-qualification letter based on the information you've given us, or that we've gone over the phone, or you've given us. And then once you get in a contract with, now Hancock Whitney do not issue pre-approvals.
Okay, that was my next thing. Can you tell us the difference between a pre-approval and a pre-qualification?
Okay, pre-approvals mean that the lender has received all of your information, check stubs, bank statements, tax returns, pool credit, whatever, and they have you approved or issue a pre-approval. Okay. Well, we don't do that, because until we get a contract, a pre-approval, conditional approval, that's the property, the value. If you've taken our disclosures and returned them. So that's an approval. A pre-approval and a pre-qualify is totally different. We don't issue pre-approvals at Hancock Whitney. We issue pre-qualifications, because at that time we have not verified. We have not sent out a VOE to know if the check stuff that you gave us are accurate. We haven't sent out we haven't pulled tax transcripts. We do pull IRS tax transcripts from a third party. And when we do that, we checking accounts to make sure that you do not owe the IRS. Usually, if you do owe the IRS, when we pull, because that's part of the approval, you may not have told us that you owe the IRS for 2018 or 2019 taxes. So then when we pull the tax transcripts, because you've given us your tax returns, but you did not tell us that you had not paid your taxes. When we pull the account tax transcripts, then we see that you owe the IRS a balance. Then we're going to ask you, because if we put you out there with a pre-qualification, that's why we don't do a pre-approval. Then you have not set up any type of agreement with the IRS. You can pay as long as you owe the IRS and have an agreement in place, and you have paid that agreement as agreed. Now, what our underwriters look at, they'll look at if you have an agreement, say you owe 2021 taxes, and the IRS said, okay, you can pay us as agreed. We will get the agreement. We will get 3 months of your bank statements to make sure that you paid that IRS payment as agreed, and then we move on. So those are things that we're looking for in the back. The reason we don't give pre-approval, because those are things that come up at the end when a person get a pre-approval. They say, well, I thought you told me I was approved for this house. Well, we didn't verify anything. I didn't know that you owe taxes. I didn't know that there was a judgment out there that you didn't disclose. It wasn't on your credit report. Sometimes those things don't come into play until we request title work. It wasn't on your it wasn't on your credit report. Now, we were told after 5 years or so, the credit bureau may not, they're not required to report some things. So when we get title work, that judgment have been out there over 5 years. So that's when we see it. That's why we don't issue a pre-approval. We issue a pre-qualification, because those things sometimes come up at the back end when we're ready to close.
That
you
makes
or get
sense.
close to closing.
That makes sense, and that's very, very good information. Victoria, did you have something to contribute?
Yeah, just to kind of like simplify it for individuals in the audience, just based off of HUD's definition of the difference between a pre-qualification and a pre-approval, is that a pre-qualification is just based off of unverified information. So just whatever income you tell the lender and whatever debts you have. And then they say, boom, here's what you might qualify for. There's no guarantee you're going to be approved for that amount. Once you give them the hard documents, pretty much guarantee that it's not going to be the same amount as what you were originally issued with the pre-qual. The pre-qual is solely just for you to have an idea to be able to shop around for homes that are within your price range. And then pre-approval is based after that verified information has been collected. So the, income documents and the whole picture.
And usually that don't happen until the documentation is submitted and we have check stubs, bank statements, tax return, and our processors have received verification of employments back. So.
Okay, we have about 2 more slides, and in the interest of time, we have about 10 more minutes. I do think it's worth doubling back to some of these questions. Victoria, they asked, how long is the certificate good for? The certificate that we
Yeah, our certificate of completion from the homebuyer education course is good from 2 years that it's issued. And to touch on that right quick, I mentioned earlier that we still have our in-office classes postponed, but our first one will be on June 17th.
June 17th. And is it, what's the commitment? You said it's face-to-face. Is it in once a week? Do y'all do it Monday through Friday?
It's basically an all-day course. So we don't have it split up into different sections. It's all done in one day. It's typically from 9 to 3. We do provide continental breakfast, and we do provide lunch. And then there is a fee. It's $40 for individual or $45 for a couple. And it doesn't have to be like, in a relationship, but 2 individuals who are looking to purchase the same home.
Sure. And then we had a question about what is the application process timeframe? I'm assuming the application that you're reviewing. I think what we understood you to say is that from start to finish, it could go pretty smoothly. But it is contingent upon the underwriter or other people getting to, in that process that we learned about earlier, saying, hey, wait a minute, you forgot this, or you don't have that, so that time frame varies, correct, on how long that application process could take?
Yes, because once our underwriters are reviewing all of your documentation, for instance, you may have given me, usually in the pre-qual, you may let us look at your bank statements and we're entering that information, or you may have given us a estimated amount. Well, when we're verifying that and our underwriters are looking at your asset, your bank account for your closing, to help you with, closing cost or whatever. Well, a lot of times, there may be undisclosed debt they find, they may find that you did not tell us some things about a debt. So we have to sit there and do explanation letters for you, or you'll have to give us an explanation for it. So a lot of times those things, when they're reviewing all of your documentation, if it's clean, there's nothing to do, we can get something closed, like she said, in 30 to 45 days. Even sooner than that, if everything is on point. But if there's things that we have to question you about. We have in some of the cases, people don't think that NSFs are important. Well, when we're reviewing your bank statements, the underwriter, if you will look at your bank statements, if you've had NSF, even if it was January or February, your year to date is on those bank statements. They may not be on the bank statements that I receive, but it's on the bank statements. Well, she's going to ask you to explain, or we're going to ask you to explain why did you, what were those, what caused those NSFs, or what, we can't turn over statements with NSFs on it. So we will, most of the time, we'll talk to the customer and guide them through what they need to do. In some cases, we'll tell them, to explain why life happened, things happen. So that, stuff like that may slow us down. But once we get all of that cleared up, if it goes smooth, we can get you closed in 30 days. In some cases, it do take longer, just like Ms. Victoria said. It may take 60 days. If you're working with, it depends on what type of loan. If we're doing down payment assistance, we do not actually control those programs. Usually if you're using a bond loan or a down payment assistant, we actually, they're our partners. We have to work with their schedule. We have to submit the documentation that they require. Those things take a little bit longer when you're working with down payment assistance programs, but usually if we're not, and we can, get you close, 30 days is a good number.
Is a good. Okay, so 2 more slides that things that I think we definitely need to know about. Let's try to hit it in 6 minutes, because I have one last question that was put in, but I want to see if we can go ahead and go over this great information. Mortgage affordability.
Mortgage affordability, I think we are using qualifying ratios. Most loan programs, they allow you for housing to income 30%. So we take your gross, and in this scenario that we're using, it's like, I think we're using $2,500 a month. That's a $30,000 a year earning. So we'll take $2,500 a month. 30,000 divided by 12, that's 2,500, and that's 30% of your income. So let's just say we've determined by the interest rate, that your mortgage payment is $750. And then your back debt, we call a debt ratio. That's usually your housing, your gross monthly income, and your debt. So in this particular scenario, the program don't allow you to go over 43. Let's say that's 750, and we've determined for this scenario 1,075. That's like $325 worth of debt. So your income and your debt to stay within the 43% debt ratio is $1,075. So that's on $30,000. The example shown is for the purpose, it reflects, it don't reflect all scenarios for individuals, but all programs have a housing to income ratio and a debt to income ratio. So that's your gross income versus and your liabilities. When we look at your credit report, that's the housing amount and the debt, the back debt. And I think your monthly payment is around $750 and your debt is $325. So that's pretty much how we determine your ratios, by your gross and your debt.
LaCarsha, did you want to say something?
No, I was just gonna say awesome information, great presentations, Victoria, as well as Stephanie. I love it. Good information. Great questions from our audiences as well.
Absolutely. So can you go to her last issue? Okay, sorry. That's her last slide. I was waiting for a cue and I missed the cue. This is the last slide that Ms. Stephanie was talking about, the housing ratio and the debt ratio. gross month income, and then the gross month income with the, what she was talking about here. So I'll keep that up as we, just so you can have it and look over it a little bit more. I want, we had a question. What part of the application process is a hard pull done on your credit? Pre-qualification or conditional? Or is it pulled regardless?
It's the conditional approval. If you, we will pull, if you authorize us to pull your credit during the pre-qualification, we will do that. But sometimes it takes a minute for you to find a house, and we have you in the pre-qual sitting there, but then when you get in it, say it takes you about 6 months to find a house. Well, we have pulled credit, but we'll have to put an updated credit report after 90 days. So I would say the conditional approval is the important credit report.
Okay.
Because in the pre-qual, that credit report could have expired by the time you find a property.
Okay. Are there any other questions that everybody should, everybody should be allowed to talk now. You're still on mute automatically, but you can take yourself off mute if you wanted to ask a question, or of course you can always put it in the chat. We have a couple more minutes. We did start a little late, so just want to make sure that you don't have anything else. And as those questions come in, or if you get off mute, does anybody else have any last thoughts that you want to share based on this great information provided? Victoria, is there anything else you want us to know about the services that y'all provide? Is it based off of, is it anybody, or is it based off of any socioeconomic level? Anybody can come?
We'll take anybody.
Okay. And they just call the office directly and get hooked up with.
Yeah, they can call our office, or they can send me an email. I was just about to put my information in the chat.
Yes, please do. Well, if nobody, I don't see any questions coming in, nobody getting off mute. Let's see, make sure. Okay, Victoria's putting her her information in, but essentially it's Mercy Housing, and it's located in Gulfport. So if you just Google that number, or look up their website, and that sounds like definitely the way to go, to be sure to have someone that guides you and connects you with the right resources. I want to thank Hancock Whitney for pulling this together. I mean, they are troopers, and I love the title community partner, because that's really what you are, and then community lender, and that connotes exactly what you are and what your commitment is to people who want to become homeowners, and and other initiatives that Hancock Whitney is engaged in. So if you have any friends or family in the Tampa, Florida area tomorrow night, we would love for you to recommend them to go to sit through this same seminar, or if you miss some information, it's going to be the same information. Obviously, we won't have a local community partner from Gulfport on that one, but send your friends and family to that one so they can get some of this great information. IamLegacy.org is where you can register, and you can send them to. Keep in mind again that we will be doing 2 more series, two parts. Series 2 is going to be in where we May, and then series 3 will be in June. So I've got your email addresses. So look at the outlets in which you found this information, but we'll be able to get those out to y'all since we captured it in your Zoom registration. And if nobody has anything else, I just want to tell y'all thank you again. This has been fantastic information. I learned something every time I sit through and hear it.
Thank you so much for having me. It's been fun.
Thank
Absolutely.
you. Y'all have a
Thank
good
you,
night.
everybody. Enjoy the
too.
rest of your evening. Thank you, Stephanie, Victoria.
All right, you're welcome.
Thank you.